Welcome to Money Mike. Today we're breaking down one of the biggest financial disasters in modern history, the 2008 financial crisis. This wasn't just a bad year in the stock market. Banks were collapsing, millions of people lost their homes. The entire global economy was on the edge. Some experts even said it could have turned into another Great Depression. So, what actually happened? How did regular home loans turn into a worldwide meltdown? And why didn't the whole system completely fall apart? Don't worry, we're keeping this simple, no Wall Street jargon. To understand the crisis, we need to start with one basic idea: a mortgage. Before we can understand the crash, we need to understand one simple thing: a mortgage. A mortgage is basically a loan you take out to buy a house. Most people don't have hundreds of thousands of dollars sitting in their bank account. So they go to a bank, and the bank lends them money to buy the house. In return, the borrower agrees to pay the bank back every month, part of the loan plus interest. If the homeowners don't pay, that's called a default. And if that happens, the bank can take the house back. That's called foreclosure. Now, here's something important: the bank gives you the mortgage, usually doesn't keep it. Instead, they sell the loan to other financial companies or investors. That means the bank gets its money back quickly and can go give out even more loans. For a long time, mortgages were pretty safe. Banks only gave loans to people with stable jobs, good credit, and enough income to afford a house. But in the early 20s, something changed. And that change is where the real problem begins. So, what changed? Investors around the world were looking for a safe place to put their money, somewhere they could earn better returns than government bonds. And US holding looked perfect. Instead of buying one single mortgage, big investors bought something called a mortgage backed security. Here's how it works: banks would take thousands of individual home loans, bundle them together into one big package, and then sell pieces of that package to investors. So instead of owning one mortgage, investors owned a tiny piece of thousands of them. If homeowners made their monthly payments, investors earned steady returns. And since housing prices kept rising, it seemed almost risk free. Even better, credit rating agencies have many of these mortgage bundles. The highest rating possible, AAA. That's basically Wall Street's way of saying this is extremely safe. So investors kept pouring money in these securities. And because investors wanted more, banks needed more mortgages to bundle. That's when lending standards started to drop. And that's when the real risk quietly began building beneath the surface. Since investors wanted more mortgage backed securities, banks needed more mortgages to package and sell. But there was one problem: they were running out of qualified borrowers. So instead of slowing down, they lowered the standards. Banks started giving loans to people with low income, poor credit, and unstable jobs. These were called subprime mortgages, basically high risk loans. Some lenders didn't even verify income. If you said you made money, that was enough. Others offered adjustable rate mortgages. These loans started with very low monthly payments. So they looked affordable at first, but after a few years, the interest rate would jump and payments would skyrocket. Many borrowers didn't fully understand what they were singing, but banks didn't seem worried. Why? Because they weren't planning to keep the loans. They would bundle them up and sell them to investors anyway. As long as housing prices kept going up, everyone believed the system would work. But underneath the surface, risk was building fast. And once housing prices stopped rising, everything started to fall apart. For years, housing prices kept going up. Everyone believed real estate was guaranteed investment. If you couldn't afford your payments, no problem. Just sell the house for more than you paid. But that only works if prices keep rising. Eventually, they didn't. Home prices stopped climbing and they started failing. At the same time, those adjustable rate mortgages began to reset. Monthly payments suddenly jumped higher, sometimes by hundreds or even thousands of dollars. Millions of homeowners couldn't afford the new payments. They defaulted. Banks started taking houses back and putting them on the market. But now there were too many homes for sale and not enough buyers. More supply, less demand. prices dropped even faster. And there's real problem. As home values collapsed, those safe mortgage-backed securities weren't safe anymore. They were full of failing loans. And now, the financial system was serious trouble. But the crisis didn't stop at bad mortgages. Wall Street had built something even more dangerous on top of them. Banks and investors were trading complex financial contracts called derivatives. One of the biggest was something called a credit default swap. Think of it like insurance. Investors who owned mortgage backed securities could buy these swaps as protection. If the mortgages failed, the seller of the swap would cover the losses. Sounds safe, right? The problem was this insurance wasn't regulated. Companies like AIG sold billions of dollars worth of protection without having enough money to actually pay if things went wrong. And when mortgages started collapsing, everything went wrong. Suddenly, these insurance sellers couldn't cover their promises. On top of that, traders were making massive bets on whether these mortgage securities would fail or survive. So, when housing crashed, it wasn't just a few bad loans. It was giant web of risk snapping all at once. By 2008, the damage was impossible to hide. Major financial institutions were drawing in losses. No one knew which banks were safe and which ones were full of toxic assets. Trust disappeared. Banks stopped lending to each other. Credit markets froze. Businesses couldn't borrow money. Even healthy companies struggled to get short term loans to operate. Then came the breaking point. Lehman Brothers, one of the largest investment banks in the world, declared bankruptcy. That sent shockwaves through the global economy. The stock market crashed, retirement accounts were wiped out, millions of Americans lost their jobs. Panic spread everywhere. People weren't just worried about losing money, they were worried about whether the entire financial system would survive. The economy officially entered a deep recession. And that moment, the government had a choice: step in or risk a complete collapse. Faced with a collapsing financial system, the government stepped in fast. First, the Federal Reserve started lending emergency money to banks. The goal was simple: keep banks alive and prevent total panic. Then, Congress passed something called TRAP, the Troubled Asset Relief Program. It set aside 700 billion to stabilize the financial system. A large portion of that money was used to inject capital into major banks, helping them stay afloat. The government also stepped into risky companies like AIG and even helped auto manufacturers survive. At the same time, Congress passed a massive stimulus package, over 800 billion, to support the economy through spending and tax cuts. The idea was to stop the free fall. Slowly, the panic began to ease, but the crisis left scars, and it raised one big question: how do you stop something like this from happening again? So, what did we learn? One big lesson was about initiatives. Mortgage brokers made more money by approving more loans, even risky ones. Banks took huge risks because they believed they could sell those risks to someone else. And some firms assumed they were too big to fail, meaning the government would rescue them if things went wrong. That's called moral hazard. Thinking bigger risk because someone else might pay the price. In the end, the crisis wasn't caused by 1 billion. It was a system built on greed, overconfidence, and bad decisions. And systems built like that eventually break. Thanks for watching.